Pleasure to welcome Sébastien Houde for the second time of this seminar series suite. So Sébastien already has a significant professional experience that goes from Resource for the Future to ETH Zurich through University of Maryland. And currently, Sébastien is at Ecole, Grenoble Ecole de Management that is actually sharing the research lab IREG with University Savoie-Mont-Blanc. So today, Sébastien is going to present us a paper about consumer myopia in vehicle purchases, evidence from a natural experiment. So before you start, I'm just recalling how it's going to happen during this seminar. So you can ask as many questions as you want on the Q&R window. In case it is clarification question, I will interrupt Sébastien and ask the question for you, mentioning also your name. And in case it is more general question, then we will probably wait until the end of the seminar. Maybe I will, if there are a sufficient number of questions, maybe I will make a break after 20 minutes of presentation and submit some of these questions to Sébastien. So now, Sébastien, the virtual floor is yours. And, I'm very enthusiastic to hear your presentation.
Thank you for the invitation. It's a real pleasure to be with you virtually. This is a complicated and a very special time. I guess like most of you have been talking to a white wall quite a bit in the last few months, but please jump in, interact, throw hard, easy questions, comments. They are very welcome. So that's a paper that is toward its end of life, I would say, but this is a research agenda that I've been working quite a bit in the last couple of years. So the broader research agenda is how consumers value energy costs. Okay, so this paper falls in this broader literature. And okay, sorry, I just want to acknowledge my co-author here, Kenneth Gillingham and Arthur Van Benthem. Both are former colleagues of mine in grad school. So it was really fun to work with them on this project because we reconnect from our time in grad school. Okay, so here we'll think about fuel economy standard. This is the motivation, the policy motivation of this paper. Okay, as you may know, okay, they are widely considered to be second best policy by economists. Why? Because it's not the best way to regulate transportation and the externalities associated with transportation. Some of the perverse effects that we have because of fuel economy standard are the rebound effect, meaning that as we make car more fuel efficient, that reduces the private costs and people might be driving more. There's also an impact on the secondary market. Okay, if you increase too much the price of new cars because you make them more efficient. If you only have, for instance, Tesla as a new cars, people don't have the means to buy Tesla. So they will go on used car market and they will buy vastly less efficient cars that they will do without a regulation that force everybody to buy a Tesla. Okay, there's a name for that, and this is, I will not be adventurous enough to try to pronounce that name. Okay, and it induces also maybe distortion in terms of product line decision. Manufacturers compete through product differentiation. This is not perfect competition. And you might see kind of perverse effect of having too much product, too much vehicles on the market. Okay. Nonetheless, fuel economy standards are the most prominent policy in Europe, in the US, to account for the carbon emission and also other emissions from transportation. Okay. And the key policy parameter in determining whether or not, well, one of the key, I should say, okay, there are a couple of them, but this is whether or not consumers value fuel operating costs. And there's a long debate on this question. And I like to say that for us, energy and environmental economists, that parameter is a bit akin of the elasticity of labor supply for labor economists. Okay, this is an ongoing, never-ending debate There are different ways to estimate that parameter, okay, in our context. There are different results. There are different segments of the population that we should care about. There's heterogeneity, so on and so forth. So this is a, you know, infinite source of papers. The downside of that is, you know, for people not in this you know, specific subfield, it might sound a bit boring or repetitive. Okay, so what I will try today, at least, is to show you that this debate is still quite active. I think our paper kind of revive even a bit more the controversy, and this is why that even though this paper is toward its end of life, I think there are many, many more things to do in this field, and this is one of the things that I'd like to share with you. Okay. Okay, so I think, you know, if you haven't thought about this for a while, let me remind you how economists think about standards. Usually, standards increase the price of new vehicles. Okay, this is a new technology that will make vehicles more efficient, but more expensive. The good thing for consumers, although they will pay higher prices, they will receive fuel savings. So in a perfectly working economy, you know, the market equilibrium should be such that consumers adopt more efficient vehicles up to the point that the private costs, you know, at the margin, as we are on the Pareto frontier, at the margin, the private costs of adopting more efficient vehicles equals the private benefit, okay, at the margin. So there's no opportunity to raise fuel economy standard and have a so-called win-win, that is, increase social net benefit because we internalize the externality, and we make consumers better off because we provide, you know, energy savings to them that they will not have accounted for. Okay, so the view of the economists is that if you increase fuel economy standard, you might increase social welfare because you internalize externality. If you don't create too much perverse effect, net social welfare will increase. Okay, but on the private benefit side, consumers, if they are optimizing, there is nothing to gain there. So there's only a cost from the consumer point of view. Okay, but this long literature says, you know, consumers are not optimizing at the margin. They might be inattentive. There are behavioral phenomena such as salience. Maybe there is more neoclassical reasons why they don't account fully for the fuel costs, the future fuel costs. Some consumers might be capital constrained, you know, problem with access to credit, so on and so forth. And maybe there's also a supply side reason, okay, why it appears that consumers undervalue fuel operating costs. If automakers make decisions in equilibrium such that they believe, this is as if consumers have a short, let's say, payback period or undervalue fuel economy, it would be as if consumers undervalue fuel costs in equilibrium. Okay, so you have a bunch of explanations basically on the supply side, on the demand side. Okay, and we can imagine we have cases where the private costs, the private benefit might even exceed the costs. Okay. Quickly, this is a great literature review that David Green did for the EPA, okay, in 2010. It's not published in a paper. This is an EPA working paper, but he did a very thorough review of the literature. And this is what he found, okay? This is an histogram of the number of studies that show undervaluation of fuel costs. So let me define first, okay, undervaluation of fuel costs. There's a term that economists have used in the literature is myopia toward future fuel costs. I will use myopia, but I don't like myopia as a term here because myopia is just one among many other behavioral phenomena that could explain why consumers undervalue future fuel operating costs. And just to be clear, what it means to undervalue future fuel operating costs, it means that if you increase the price of a vehicle by $1, consumers will okay, and you measure the behavioral response. There is undervaluation if you increase the discounted fuel operating costs by $1. The behavioral response will be different. I don't know if I mixed that out, but basically, do consumers respond the same way in variation in upfront price versus discounted fuel operating costs? If this is not the case, if they respond more to the purchase price, then we will say, okay, there is undervaluation. So this whole literature is trying to measure those two behavioral response, or the ratio of those two things, if you prefer, and see, okay, is the magnitude of the behavioral response the same for the purchase price versus discounted fuel operating costs? And in this literature review of about 25 studies, he found that there's a substantial number of studies that show undervaluation. Some of them, a fair share, about 30%, found there's no undervaluation. Okay, this is about 1-to-1. And some of them even find overvaluation. And there's a range of ways to measure that. So I will discuss that later on, but you can use discrete choice model, which has been kind of the historical way to do this. You can use hedonic methods that have been also a popular way. And there are other methods that I'm not fully familiar in this literature review, but you can use also other methods. So that is kind of the state of the debate in 2010. But you need to know that the EPA, up to 2010, they strongly believe that there is undervaluation. And in fact, even as of today, I would say even in other countries, I was talking to regulator in Canada last year. For them, the one that set the standards in Canada, they strongly believe that, based on the marketing studies they do and so on, that there is a strong undervaluation of fuel operating costs. But then, among economists, not so much. Okay, starting in 2010 and so on, the same time that you had the credibility revolution, you had a couple of very well done, very thorough studies that have been done that try to measure exactly to which extent consumers undervalue or not fuel operating costs. And here I report the valuation ratio. Okay, I will use that number quite a bit today. A valuation ratio of 1, okay, means that consumers trade off $1 in purchase price, upfront cost, the same way that they trade off, they value, $1 in future fuel operating costs. Okay, so a valuation of 1 means there's no undervaluation. This is perfect. Okay, from the neoclassical point of view, this is what you would expect. So all the numbers in blue here, Busset et al., Alcott and Wozni, Sally, Grigolon, Leard, with Jocelyn and Christy Chou. Until Grigolon, this is all numbers that are not statistically different than 1. Okay, so all those studies, very well done, very thorough, they all find that not so much, no undervaluation. Then you have a paper from Leard et al. That they find, yes, some undervaluation. Alcott and Kenneth did the RCT and they found no undervaluation. And Leard et al. With another technique, they find substantial heterogeneity. Okay, so the range is pretty large, but on average, a lot of undervaluation. Okay. The other thing that I want to point out is all those papers, they are for the most part, quasi-experimental, and they all use a different source of variation. So some of them use gas prices as the natural experiment. Okay, so the idea is that gas prices vary quite a bit over time, and they use the up and down of gas prices to see how consumers respond to future fuel operating costs. And the idea is that when a consumer arrive on the market and purchase a car, if he face really high gas prices and expectation of really high gas prices, that provides a situation where, he should pay more attention. He should prefer cars that are more efficient because future fuel operating costs are more expensive. So that's the idea of gas prices. Sade et al. Use a very quirky and way to use odometer reading to create also a quasi-experiment with that. Grigolon et al., this is more a structural paper, and they use gas prices with the change in technical attributes to estimate how consumers value future fuel operating costs. And Leard et al., the two papers, they focus on technical attributes also. And Alcott and Kenneth, finally, they use the RCT, where they provide education about fuel operating costs and see how consumers respond to that. Okay, so that's the state of the literature. I can tell you that based on that, the consensus up to, we are trying to move that, but the consensus, at least in the US, is that there is no undervaluation. Okay, so undervaluation of fuel operating costs is not a rationale for a policy intervention such as standard. Okay. Our work, okay, consists to exploit a different source of variation. Okay, and we claim that we are the first to use variation in the official fuel economy rating that the US EPA is using. And we argue that this variation is, okay, it's just not the, interesting, but it's also really policy relevant, because if you think about it, the way that fuel economy standards are communicated to consumers is through a change in information in official fuel economy rating. Among our co-authors, we have different opinion, but in my view, I don't believe that as cars become more energy efficient, you change technology. I don't think that consumers have a good understanding that how the technology is changing. What consumers see is different fuel economy rating labels, and this is the main way that we can communicate that, okay, we have fuel economy standards that are maybe more stringent. That would change the fuel efficiency. Okay, there's a change in attributes and so on. But what consumers will really see, okay, is a change in fuel economy ratings. So to be able to exploit that source of variation is very relevant to think about fuel economy ratings. Variation in gas prices, this is relevant, but for me, this is more relevant for a policy intervention that will impact gas prices, such as a tax. So now, up to today, we have used those estimates, okay, to study fuel economy rating, but we didn't pay attention to the source of variation. One of the points that we want to make in this paper is like, wait a minute, you should be careful, because you have, as we'll see, we'll have variation. Our valuation ratio is much different than that, but the source of variation is also different. And our source of variation, from our point of view, is more relevant for studying one type of policy, fuel economy rating, not so much for gas taxes. Okay, so that's one point that we want to make. Okay, and what we find quickly is, on average, vehicle prices respond to a change in official fuel economy rating. And I will discuss the change that we are exploring, but long story short, we have a natural experiment. Okay, one thing to keep in mind is a lot of people have tried to run experiments changing the official fuel economy rating. That has been impossible so far because by law they are fixed, and the EPA never accepted to do an experiment to change those fuel economy rating. So what we are doing in this paper is we are exploring a restatement where some manufacturers had to change their fuel economy rating because they made a mistake at some point when they tested their vehicle. Okay, so we have this natural experiment that provides variation in information on the official fuel economy rating. And we find that, okay, the market responds to that. Okay, so there's a little change in price. And when we translate that change in price and valuation, consumers' preference, we find substantial undervaluation. Okay, so the valuation ratio is 15 to 38%. I think it's a good time. Okay, I will dive now, explain what this is about, the natural experiment. I'll discuss quickly the data, empirical strategy, and now we back out the fuel economy. But if you have questions at this point, I think this is a good moment. We can discuss that, and then if not, I will dive into the main presentation.
You must have been very clear so far, because I don't have even clarification question to ask you, so you can just go on.
Perfect. Okay, this is the fuel economy rating in the US. Okay, a lot of information. Okay, it change from time to time, but this is mainly what you have. And the main number is, okay, in the US, you have miles per gallon. Okay, it's a bit hard to conceptualize, but how much driving you do for 1 gallon of gas. Okay. An estimate of annual fuel costs in comparison and so on. Okay, so what happened in 2012? EPA did a random audit, they do that once in a while, of vehicles from different manufacturers, namely Hyundai and Kia. And they found that the fuel economy values that they reported were overstated. Okay, so in practice, they had much lower realized fuel economy values. Okay, they talked with the automakers and so on, but the automakers acknowledged that they made the engineering procedural errors in measuring the fuel economy rating, and so the EPA pretty quickly said, okay, you have to change that. So then what you have is about 44, a subset of vehicles of models sold by Kia and Hyundai had to restate their fuel economy. And that happened pretty quickly, okay? So that was in November, and it unfolded, in a matter of days almost, that it was discovered, they acknowledged, and then, boom, new ratings were produced on websites, new labels were printed and put on the cars in dealerships and so on, okay? About half of the cars sold by those manufacturers were affected. So this is pretty large. So for us, this is a very nice natural experiment, okay? So just to give you an example, quickly, you have also different type of cars. You have the small SUV, small cars, so on and so forth, okay? And this is, the magnitude of the change for a couple of those models. The magnitude of those, okay, just so that you know, the magnitude of those change, when you translate that in future fuel operating costs, it resembles the magnitude of the change that papers that use gas prices as source of variation. Okay, so one reason that we might find another number that those gas prices paper might be that, okay, the change were so small that people didn't bother to re-optimize or think about this. But when we look at if you look at how those MPG numbers or change in MPG numbers translate in change in fuel operating costs, it resembles the variation that you have in gas prices over time. Okay, so we are on par. Okay, we have a similar natural experiment in terms of magnitude. Okay, information shock, if you prefer. Okay, and I don't want to spend too much time, but this is how it happened. 2012, November, EPA said, boom, press release, those models have to be restated. It came pretty much as a surprise. We did a lot of search in the news. If we had complaint before that from consumers, we don't find evidence that it was anticipated. And then all the numbers changed on the website and also at the dealership. Okay. And you should know also that Hyundai and Kia were kind of the leader in some car segment in terms of MPG. So they were kind of pretty happy to have those nice MPG numbers, and they were doing a lot of advertising related to MPG. So the information was out there, regarding that. Okay. So this is our opportunity. We'll observe the same model, okay, the same car model. We'll keep all attributes constant, but then we'll have a different fuel economy rating. So think of a car with a label. We'll change the information, the label on that car. Okay, so this is our natural experiment. Thanks to my co-authors that have been working in the car market for many years, we had great data. So this is transaction price level data in the US dealership. That covers the period before and after the restatement. Okay, we collected gasoline price and other variables also to do more things that I will discuss later. But the idea is that what we have is transaction price. So when people bought a car, how much they paid. Okay, and we have information. It's not perfect, but we have pretty good information on the other rebates that are often offered in the US when you buy a car. We don't have the term of the leasing, so that's something to keep in mind that we'll have liked to have that, of course. Okay, so quickly the data. Let's not spend too much time, but let's look at let's look at that line, the price in thousands. Okay, the affected model sell for about $21,000 US. If you look at other cars that were not affected, the average price of a car in the US is about 28. Okay, so we have models that are a bit cheaper. Hyundai and Kia this is not the Mercedes and the BMW or Ferrari of the market, of course. So they are a bit, more the cheaper and more accessible cars. So one interpretation of our result is we have a natural experiment that focuses on the particular consumer segment, and this is one way also to explain or to limit the scope of our estimate. We don't think this is a big critique, but I want to mention it. Okay, so very simple what we do. Okay, at the end, this is something akin of a diff and diff. We have, let's think about it. Okay, so you have a car offered by a given manufacturer. So not all car models will be affected for this given manufacturer. Okay, so one thing that might happen, if you think about what happened with Volkswagen with the Dieselgate, there were probably a pretty big brand effect. Okay, you might think that that will also happen here. Okay, but the fact that you have a subset of model within a brand affected means that you can control for that brand effect. Okay, so we will have a car model fixed effect. Okay, so what is a car model? In the US, they call that a Benthem. This is a pretty detailed definition of a car. So the type of engine, model, trim, model year, and so on. So this is a pretty well-defined car characteristics. And then we see variation in over time in whether or not the label change. Okay, so you have a subset of model within a brand affected. You have a pre and post period. And so the interaction of those two things as a definitive design is our effect of the restatement. Okay, so the first thing we'll do is we'll simply measure if the transaction price responds to the information shock, the restatement. Okay, we control for time trend, and we are pretty, different time. We account for different time trends to account for the fact that different vehicle class might be affected by change in gas prices over time, advertising, so on and so forth. And what is key here, you have the time of the month, okay, month of sample fixed effect interacted with the make. So that is capturing all the brand effect over time. So if you think that the brand was affected negatively, that will be absorbed by this interaction here of month of sample with a dummy for each brand, each make. Okay. And we have variation, we have also controlled for region, maybe some DMA marketing area were responding differently or subject to different time trend. Okay. Any question on the empirical strategy? This is, fairly standard, transparent, diff and diff here.
No question so far.
Perfect. Okay, so if you remember your mostly harmless econometrics book under your pillow, diff and diff hold under some assumptions. The pre-trend need to be the same. You don't have to, SODVA must hold. What is the SODVA? This is the stability of the unique treatment, forgot the VA, something, meaning that, okay, SODVA in plain words, your treatment should not have the treatment should have a direct, you should not have a spillover effect from your treatment effect. Okay. What it means to have a treatment effect, well, especially in this context, it means that is the restatement, okay, impacted the price of only affected model or also affected the price of non-affected model. And then you can think, okay, this is the car market, this is a strategic market, this is not perfect competition. So you might think that SODVA must not hold. Okay, we did substantive, I would say, robustness checks to show that, okay, those strategic effects of the price, the restatement impacted the price of treated and non-treated vehicles. It's not a problem in our case. Okay, and, if we have time, I can spend a bit of time discussing what we did. So without further ado, this is the diff and diff estimate. Really simple. Okay, we have the price or the log of price as the outcome variable, and then we show, okay, what happened if a vehicle is being restated in the post period. Okay, and we see a decrease in that is a 0.01. So this is a 1% change in transaction price. this is statistically significant. Different type of fixed effect trends to account for a pre-trend and so on. In dollar, this is about 150 to, I don't see because of the camera here, $294. Okay, so this is a small change in price, statistically significant, and that is our response to the first question. Does the market value official fuel economy rating? And the answer is yes, a little bit. Okay. Perfect. Okay, so this is a classic event study graph. We don't have a lot of statistical power to do those dynamic effects. So this is mostly the individual estimate in the post-treatment period, or a few of them are statistically significant. But you see still clearly that, there was an impact on price. It seems to drop right at the moment that the restatement was announced. Okay, so all of that together is what we are finding. Okay, all of that together is statistically significant, and it's about 1% reduction in price. What about sales? Okay, so the market response could be also that sales change. For sales, we don't find anything robust. Okay, this is different specification where we try to cut the sample in different manner. Basically, we run the same regressions, but we try to be less or more conservative and so on. We don't find any effect that is statistically significant. If anything, we see a positive effect, as if the restatement increased the sales. We don't believe that this is what is happening. We have a broad range of estimates, and the positive and negative number are covered by the confidence interval. Okay. So our finding is, regarding sales is not so much. And we have a bunch of reasons why we think, there's an impact on price, but not so much on sales. If you think about the nature of the natural experiment here, I mean, the impact was, first of all, in November 2012. So for those model years that were impacted, all the inventory decisions were made. Okay, products, I mean, vehicles were on the dealer lot, were inventory, they were out of the, of the factory. So there was not much possibility to adjust sales. Okay, so products, I mean, the vehicles were built, and the dealership had to sell those. So the only mechanism that they had to clear the inventory was to change prices. For model years, so their statement was in 2012. 2013 model years were also affected by the restatement. There, I can see, maybe there was some adjustment in the number of product, vehicles produced. So we can see some costly adjustment in the number in the inventory at this point. Okay, so you will see I will return to that. Sales is pretty important to think about how to translate those 1% or 294 number in consumers' willingness to pay. But keep in mind that we don't find so much with sales. Okay, but we'll play with that later. Okay, so what do we do? So that's the first part. So we could have written actually the paper initially was just that. Was done. We submit, all good. Then we ask ourselves, could we, we have all those nice papers that compute evaluation ratio. Is there a way for us to also back out that number? And then the answer is yes. In fact, we can use an hedonic approach. There are broadly two different ways to back out the evaluation parameter. There are discrete choice model, kind of the old and classic way, and there is hedonic approach, more the quasi-experimental way. Okay, so we follow the framework of Alcott and Woolsey pretty closely, and that was the goal here, to say, okay, look, that paper, Alcott and Woolsey, is super well done. Let's us use that same paper, that same method, those same assumptions, and let's show you, what is our number. Okay, so this is purposefully we follow step by step what they do. Okay, so first thing to keep in mind is to interpret a change in price as a change in willingness to pay for consumers. You have to think about the supply side. Okay, because the demand. Okay, so we have demand here for fuel economy. What we find is, what the way to think about the restatement is, cars were less efficient than expected, so that should reduce the demand. Okay, So we should go from the blue to the gray. And this is what we find. We find a change in price due to a shift in demand because information change and the cars are less attractive because they have higher fuel economy. In a market that supply is fully inelastic, the change in price should translate exactly in the change in willingness to pay. Okay. So if we can argue and convince you that the supply was perfectly inelastic, the $294 that we found is in fact not only a change in price, this is a change in willingness to pay for fuel economy. Okay. If supply is elastic, okay, the change in price will always be a bit smaller than the change in willingness to pay. And you can work out the 101 graph here. For the sake of time, I will not do that for you. But in our case, we think maybe in 2013, this is more the situation. So maybe that is for the 2012 model year. That is maybe for the 2013 model year. So what we'll do in our evaluation exercise is we will play. We'll play with assumption with respect to how much supply elasticity we have. And we'll provide bounds to show how much is our evaluation parameter for different slope of the supply curve for new vehicle. Okay. Then you might think, okay, imperfect compilation, yada yada, will change things. We work out also how it works. For the sake of time, let me skip that. But again, the change in price that you'll see should be smaller than the change in willingness to pay. Again, with some assumption on elasticity, you will be able to provide bounds on how much it matters. So the way it works, okay, to quantify how much consumers value fuel efficiency is by simply running a really similar regression than we had before. But here, instead of having our diff and diff like pre-post affected vehicle, we constructed a variable, and that is future fuel operating costs. And this future fuel operating costs, the variation that you have here is the variation coming from the restatement. Now the question is, for a $1 change in future fuel operating costs, how much price variation you will have. So the way to think about it is basically what we are doing is the exact same regression that we did in our reduced form part, except that you have treatment intensity. We are basically interacting somewhat more complicated manner, but interacting the magnitude of the fuel economy restatement. Okay. So delta G here will capture the change in future in discounted fuel operating costs due to the restatement. And so to construct delta G, you need a bunch of variables. VM, how much driving people will do on average, discount rate, the expected lifetime of a vehicle model, and so on. So there, again, we use all those papers. Okay, we were pretty exhaustive. It was exhausting also to do this, but we collected data. We used the same data that the Bekesi, Busset, Kenneth, and Zettelmeyer, the ER paper. So, okay, we'll use your number. Alcott and Wozni, you make those assumptions. We'll use those assumptions. And we did all that to construct our delta G, okay? And we run all those regression for different way to construct G, different discount rate, big debate also which discount rate you should use, so on and so forth. We did all that in detail. And then what you back out here, the gamma here, the gamma is your evaluation ratio. If consumers trade off $1 in discounted fuel operating costs, the same way that they trade off $1 in the purchase price, you should see a gamma equal to 1. So now you have this really nice hedonic regression where right away you have your evaluation ratio, and your hypothesis test that you have to run is whether gamma equal to 1. Okay. There's a discrete choice model behind that to get that hedonic regression. And there is a bunch of assumptions to make it valid. One of them is that sales needs to not move. So that is an assumption to make that regression valid. And we discuss again the paper why we believe that this is plausible and why we can apply that in our context. Okay, how much time I have? I have 5 minutes. Just to educate you on the debate. Not all papers are able to do this, okay, that regression. This is the beauty of our natural experiment. The fact that we argue it was unexpected and sales were not able to adjust much the restatement makes it possible to run that hedonic regression. Because basically in the error term here, we have sales. If you work out and if you take a look at the paper in the appendix, you will see that in the error term, there is a market share. Okay, Alcott and Wozni have the same problem than us, and they argue, okay, the way to have identification in their case, they say, okay, we can only run regression in the used car market. We cannot run that regression in the new car market because we know, and that is coming from Busse, Kenneth, and Zettelmeyer, the other paper, that new cars, the production of new cars, sales adjust to variation in delta G, especially if this is coming from variation in gas prices. Old car, not so much. And the idea is that old car, used car, they are produced, they are on the market. So no matter what happened, they need to be sold. It's not like you will not start destroying car because gas prices are too high. That is true up to a certain extent. Cars that are very old, 17 years old, 20 and so on, then you might think that they will be scraped, they will go they will be scraped, or they will be destroyed if gas prices are really high. So Alcott and Wozni recognize that and say, okay, we'll use used car that are used, not to use, and not use enough. So they use a subset of the used car market to run that regression. Our identification comes from the fact that our natural experiment is pretty clean, and we think that it created there was a lot of friction to change sales, okay, the inventory in cars. Sorry, parentheses close. You went really deep in that literature, but now you understand, in 2 minutes you understand that why why not all papers use that equations, because you cannot do it with a new car, for instance, and you might want to have that parameter for new car, not only used car. Okay.
I have a clarification question actually from me. So then I'm a little bit confused. Do you use only new cars or mix of everything? That's
the beauty. We are using new car, but we argue that the variation in delta G that we have is coming from the restatement, and we argue that because the restatement was so sudden and unexpected, manufacturers didn't change their inventory or their production decision.
Yeah, but
this is not. They didn't
use car as well.
The cars that were produced,
It could be done on used car as well. I mean, you could have a sample in which you have both new car and used car.
Exactly. We could, but then our restatement didn't impact a used car because the fuel economy rate label in the US are not in the used car, on the used car. So our natural experiment here is only on the new car market. So if anything, you could try on the used car. In fact, I know that Jim Sally did that during his free time at some point. We discussed with him, and he didn't find much, but it's a bit not surprising because the restatement there's no label. Okay, so there's no information shock really on the used car market in this case. Okay, so quickly, those are our gamma, our valuation ratio that we have for different discount rate. So this is between 14% and 25%. And what we did, we split our estimate for, model year 2012 versus model year 2013. And the reason for that, we think that the supply was much less elastic for 2012 than 2013. And we find evidence that are consistent with that. Okay, the behavioral response is a bit bigger for 2012 than 2013, which is consistent with the fact that if you have a supply response, you should see a smaller response in this case. Okay, so our valuation ratio that we report is somewhere in between 13% and let's say 44, for 4% discount rate, let's say between 15% and 38%. So that is much lower than what others have found, much lower than 1. So our conclusion here is like, okay, we find undervaluation of fuel costs. For the sake of time, I will skip that, but we have a way to do a bounding analysis. How much it matters, that's supply side, okay? And we found that at most, we are able to double our valuation ratio. If you double, let's say that bigger number, 38, you still well below 1. Okay, so we are not able to reach 1, even with very generous assumption on how the market might have been working at this time. Sensitivity test, quite a bit. Like I said, we just went crazy. We said, okay, it's not a critique of those other papers, but the bar is high. Those papers are really well done. So we took all those assumptions. We did it again. And everything is pretty stable. It doesn't change much. Those assumptions, taking those data, type of gas and price, doesn't matter. But there is one thing that mattered quite a bit. And look at the last line. Okay. This is the way that you compute the valuation ratio. I will conclude on that. Do I have time?
You have to be quick.
Be quick. Okay. There is one thing that changed quite a bit. Our number is how you compute the. I will go quick with that equation. That slide with plenty of equation. Long story short, the valuation ratio is a ratio of two numbers. In our case, willingness to pay for fuel costs and the change in fuel costs. What we are estimating is gamma, the expected value of that ratio. Okay, basic math. The expected value of that ratio is not the ratio of the expected value of those two numbers. And if those two numbers are, heterogeneous, in fact, you can approximate the expected value of the ratio by something that is the ratio of the means of those two things and higher order term, the covariance between those things and so on. You should know that in the literature, some papers do this. They report the ratio of means. Other paper report the expected value of the ratio. Okay, so we discovered that. Our setting allowed us to compute both. And when we use the exact valuation parameter, what we do here, and there are a couple of studies that do that, this is the valuation ratio. Other papers use the ratio of means. Okay, and we do it again, and we show that the ratio of means it increased quite a bit, the valuation ratio. So all those papers that say, hey, look, there is no valuation, there is no undervaluation, keep in mind that this is an approximation of the valuation parameter, and we don't know the direction of the bias for these papers, but in our case, it was an upward bias. So long story short, if those papers would not have found, have done things with the exact valuation parameter, it might be the case that, they would have found undervaluation. Maybe, maybe not. But the state of the debate, I can guarantee that, especially this paper, if they would have not found one, it would be very different. Okay. I will stop here. There are other reasons, different natural experiment, different source of variation. Our contribution say, hey, this is a different natural experiment, different source of variation. We think this is closer to the type of variation that the fuel economy standard would induce. And so this is one number, and the first number doing that, I think that it opens the debate. Okay, now we should produce a bit more number and see if we have real consensus that we have truly undervaluation. Okay, I'm done. Thank you.
Thank you very much. So now we can open the floor for questions. So maybe people, you can raise your hand or ask question in the Q&A window. So I hope I can see if there are people waving. Okay, maybe I can start. So actually, I had this in mind from the very beginning of your presentation, that uncertainty is clearly a large part of the story when it comes to the fuel price. I mean, they are highly volatile, so this is something that probably is very important when people account for changes in price, and it's clearly confirmed in what you say at the end, meaning that in fact, what happened, I mean, a large part of the story is that the ratio of the mean is something that is different from the expectation. So how do you exactly account for this uncertainty in your modeling? In particular,
in fuel price.
You take it probably into account a little bit through the discount rate, but you only go until 12%, and I don't know whether it's reasonable enough to account for uncertainty.
I see. Okay, so so your point is when we construct future fuel operating costs here, we have fuel, gas prices that will change, that will vary quite a bit over time, and they will be quite uncertain. And so how do we take that into account? The answer is, yeah, we try different things. That's one thing, and the other is higher discount rate. Okay, actually we did also up to 17%, 20%. I mean, we will need a very high discount rate to have a full valuation. So, I mean, in terms of range of things we have done, we haven't quantified the size of the uncertainty that it will need to get the full valuation, but I can just tell you, like, approximately that it will have to be something that is unreasonable, most likely, very, very much. Okay. Even with this, I think our implied discount rate was, to have a valuation ratio of 1 with, keeping our assumption, we need to go to, maybe it depends, but maybe 60% as a discount rate. So I think even from an uncertainty point of view, that's too large.
Okay, yeah, great.
And one thing also I want to add, the uncertainty is, I mean, there's a real uncertainty and there's the perceived uncertainty of consumers. In the car market, I mean, there's not a lot of papers, but a couple of papers that look at belief about gas prices. The martingale assumption is what consumers seems to do. It seems to forecast future price based on the today's price. So consumers are not really sophisticated in terms of expectation, it seems, with respect to gas price.
Okay, thank you. This is exactly what I had in mind, this implied discount rate. So we have a question here. Maybe, Catherine, you want to open your mic and ask it, because it's rather long. Okay. Maybe I can summarize what Catherine is asking. Okay. Or Catherine, please manifest yourself if you want to talk. Maybe I have to do something so Catherine can ask the question. Probably. So, okay. Yeah. Okay. Or maybe. Yeah, go on. Let me just summarize the question. Catherine, you are saying, okay, the sub-value hypothesis can be tested using maybe more a spatial econometric model framework, empirical strategy. Okay. And that would be a good thing to do. Okay, what we did, but you're thinking about spatial in terms of spatial, in terms of geography. Us, when we think about spatial, we think about IO type of location. The way, at least I see the oligopoly model here, is that you have a product space with car models in different regions of the product space. So affected model were close substitute to other models in the location space, right? So when we think about sub-var here, was that what we did is like, okay, let's see where products are, the affected model are, and let's see the close substitute. And that was a fun thing to do. Huh? I went online. We did the different ways, okay? But one of them is there are those nice websites saying, okay, here a car model, and they tell you based on expert, those websites, what are the close substitute of a given model. So for each of the affected model, one thing we did, we went on those websites and said, okay, according to the experts, here the close substitute. So the Hyundai Kia, for instance, as the Ford Focus as a close substitute, the Toyota Corolla as a close substitute, and so on. So those were
the non-affected model that were, from a geographical IO point of view, close to the affected model. And so what we did is to control for time trend that were different for the close substitute, or we, sometimes we remove the close substitute. We did different things to show whether or not, the presence, as we move or we control for different manner for the geographic IO sense effect, does it change our estimates? And the answer is not so much.
Thank you, Sébastien. We have another question from Yunting Yang. So saying, to my understanding, Hyundai and Kia are already relatively fuel efficient compared to other models in the US, like Mustang or Chevrolet. Would this perhaps lead to a lower estimate compared to other studies?
It goes to a bit the external validity that indeed they were a bit the leader in their car segment. Well, before the restatement, those small changes were what put them ahead of the other model. By the way, I mean the big sellers in the US for the car segments are often the Japanese, not the American car. So Honda, Toyota, and some of those car segments are Mazda are really popular. So the Mustang, we don't have too much of the pickups, and the big American car are not too much in our sample and part of our natural experience. But yes, maybe this is the case. Okay, that we have a car segment with a segment of the population that is a bit special. But if anything, it's what we wrote in the paper, and again, this is conjecture, but we believe that, if this is the cheapest model, fuel efficient, what you will attract is probably consumers that are sensitive of this dimension of the car. So if they are sensitive to that, we should find a high evaluation. So we are biased, toward 1. So the fact that we are really far from 1 means that even in this cheap, efficient, segment, people didn't pay much attention. This is one way to think about it. But conjecture, really.
Okay, do not hesitate to ask some more questions online. I had one that was relatively close to the previous one, a bit different. In your introduction, you are arguing and speaking about Tesla and speaking about standards. So I had drastically different cars in mind. I mean, whether people are ready to buy cars that will really not emit at all, not consume fuel at all. And I'm not sure your study can really apply to that. I think here you are studying a marginal change more, and not really a change in the type of car, in which case it's going to be really, it's going to be non-marginal change. So do you think we can use that to argue something really about standards that would be, not like a couple of gallons per mile, but a complete change in the engine?
Yeah, no, we are suffering from the long lag in referring and publishing paper in economics. In 2012, when we started this project, it's all about standard. Electric car was a teeny thing. And so I don't think we should use that number for electric car. The substitution between, it's a bit the message also our paper. This is like the elasticity of labor supply. We should not use the elasticity of young people or for older people or near retiree people. We should not use that numbers for simulating a change in gas tax. We should not use that number for standards that change the technology, go from electric to gasoline or gasoline to electric. And I think a nice paper to do, and this is where the literature should go, is how people account for fuel costs based on electricity. If you think about building a delta G when this is electricity costs, this is even more complex, even more obscure, and so on. So do people will still undervalue, or maybe in some manner they will overvalue delta G when this is electricity that goes in the future fuel costs? So the answer to your question is, I don't think, no. I would like to say yes, we should use that number as much as possible, but it's not a good number for electric cars.
Okay, well, thank you very much. I think the time is over. So I thank you again, Sébastien, for your presentation. And so we will meet for this seminar in 2 weeks from there. And again, for people already registered, you will receive a link in due time. So thank you very much and have a nice evening. Bye-bye.
Thank you very much, everybody. If you have
Thanks,
comments,
Sébastien.
please.
Petit message pour les membres du comité. On se retrouve dans 10 minutes.